My name is Anthony Fatsis, and welcome to the What the Finance podcast, where we interview finance, trading, and investing experts to help you understand current market trends and learn about the intricacies of new and existing assets. If you enjoy the podcast and to help with the YouTube algorithm, please like, comment, and subscribe. It really helps with the podcast. That means we can continue to get amazing guests. Thanks again. I hope you enjoy. Ian, thank you so much for joining the What the Finance podcast to talk with me about your book, Shredded, Inside RBS, the Bank That Broke Britain. So just on to my first question, sort of what was your influence for writing the book?
Well, I'd been following RBS as a financial journalist for some years, really starting at about 99. And I'd met Fred Goodwin, who was the chief executive, a few times in that capacity. And when it collapsed in October 2008, it was like a major disaster, not just for Scotland, where I live, but also for the whole UK. And I basically thought, because I already had been following the bank on a virtually daily basis for nearly a decade, that I was in quite a good position to write a book about it. I also felt that because the UK was effectively plunged into a form of austerity in the aftermath of the collapse of RBS and the other banks that failed in 2007 to 2009, that people might be interested to find out actually why had these banks failed? Was it all to do with subprime in the States, or which is what Gordon Brown was telling us, or were there other reasons which had caused them to collapse and need unprecedentedly huge bailouts?
Yeah, definitely. And as we'll find out later, there were definitely other reasons involved. And in terms of yourself getting involved in financial, journalism, what attracted you to that? Was it just interest in the markets? Was there a certain point in time?
Well, I really started my career as more of a business journalist rather than financial. And it was when I started on a paper called the Sunday Herald in 1999, which was a new paper that had just been launched. The editor, Andrew Jaspin, told me, after my initial interview, which I passed, I came back for a second interview. And during that interview, he said, I'm afraid we've got some bad news for you, Ian. One is you won't be the business editor, you'll be the financial editor. And the other is that you won't be based in Glasgow, you'll be based in Edinburgh. And I thought, well, on the latter one, actually, I prefer to be in Edinburgh because it's my home city and I know it better and blah, blah, blah. But as far as the financial thing, I actually was neutral, but I was happy to take the plunge and start focusing more on finance. So it was really him, Andrew Jaspin, who not just persuaded me, but who drove me to start focusing on finance. And when I started doing that in '99, I didn't really know the level of potential shenanigans and/or corruption that may have existed in the sector. I was pretty naive, and my main focus was on the banks, which in Scotland included RBS and HBOS, but I was also looking at other banks like Barclays and HSBC and Standard Chartered, etc. And the insurance companies, where we had still some mutual insurers like Standard Life, Scottish Widows and Scottish Mutual and others, and Scottish Life. So there was a number of mutually owned insurance companies still in '99. And I was covering all the conversions of those into PLCs. And thirdly, the third sector I was looking at was the asset managers and the hedge funds. So it was quite a wide brief and quite a lot of different things to look at. But actually, I really enjoyed it.
Yeah, definitely. And do you think that gave you like a unique perspective because you were almost coming in from outside in?
I think it did, because I wasn't really inculcated in the sector. I mean, I do have relations who were involved in the sector, including my brother, who was an asset manager, my dad, who had been on the board of Fidelity and things like that. So I was familiar with the sector from a family, because of relations working in it or being involved in it. But I didn't have any preconceptions, really. I just sort of came to totally fresh.
Yeah, so I guess that's an interesting way to look at it. So you mentioned RBS there, which is obviously what the whole book's about. And you sort of write the whole history, over 300 years of history. And apologies for my analogy, but I almost see it like, early 1990s. It's like the Titanic. It's going in the direction and it's going in the wrong direction and it sort of can't turn away. When do you think that sort of happened, that it turned in the wrong direction where it almost couldn't go back?
I think that's a really good analogy. I would say I would say Project Columbus was a turning point. And that was basically when they decided they had to focus more on shareholder value. They had to focus more on selling more products to existing consumers. So it's the, hang on, what's that called again? There's a name for it. When you've got someone with a current account and you try and sell them an additional policy, which could be insurance, or it could be savings, or it could be, other types of financial product. And you basically hollowed out the branches. And before that, the branches were almost semi-autonomous places, which had a degree of expertise in all sorts of different things, including business banking and commercial banking and personal banking, and actually were able to offer advice and judge the creditworthiness of the individual borrower, etc. Knew their communities back to front. But that all changed. They basically completely gutted the branch network and made them into sales outposts. And that all happened under George Matheson in 94 to 96, and it was called Project Columbus. So I would say that was a turning point to some extent. But I think all banks were doing it. It's not as if it's uniquely bad, or it's something that virtually all banks were doing around that time.
Yeah, definitely. And as you said, it was like a complete contrast. It went from like absolutely bloated, ridiculous, and then just completely lean, and it just changed almost in a few years.
Yeah, well, I was going to add that also there was a lot of consolidation going on during the 90s when building societies were converting, and also RBS started its relationship with Santander, the Spanish bank led by Emilio Botín. And actually at that point, it was said in a meeting between Santander and RBS that basically you had to eat or be eaten, because there was so much consolidation going on in the sector. A relatively small provincial inverted commas bank based in Scotland did not have a chance of not being taken over by a larger bank unless it took over itself. So it was desperate to acquire from about 96, but the bank under George Matheson basically failed with every single deal it tried to do. It either it got trumped, or it was too cautious. And in the end, it was really once Fred Goodwin came in, who was perhaps better at deal making, that it started to make some enormous acquisitions.
Yeah, and I found that quite interesting. It was almost like that. It was always fear that, we're going to get taken over, we're going to get taken over. So that was the banking landscape at the time, wasn't it?
It was very much so.
Constant expansion, yeah. And you mentioned there sort of, I think another thing as well that I saw was almost, as you said, it was the pride of Scotland, I think. And it was always like, Scotland on the world stage trying to, be with the big boys almost. Do you see that? I don't know if I'm.
Yeah, I definitely see that. I mean, I think Scotland had suffered so many of its, the crown jewels of its corporate landscape being taken over, and the head office moving away to London, Paris, New York, even Australia in some cases, which is what happened to Clydesdale Bank. That Scots were. I think this was a matter of concern for many people in Scotland, and it was, it's bad for the accountancy sector, it's bad for the legal profession. All the drifting away of head offices was a constant topic of discussion. And the fact that RBS seemed to be actually going in the opposite direction, or starting to, was certainly welcomed. And there was a degree of national pride in that. You saw it with the cheerleading from the sidelines of the SNP leader, Alex Salmond, during the ABN AMRO deal at a later stage. And you saw it with John Swinney, who was the senior SNP politician, cheerleading from the sidelines. But it wasn't just them. There was an entire community of Scots, whether they believed in independence or not, who wanted this bank to succeed, and were perhaps rather naively cheering from the sidelines without really appreciating the levels of risks that were being taken.
Yeah. And do you think that gave it like more of an opportunity or people, as you said, just looked over some of their shortcomings and some of the issues that they saw?
I do believe that. I think people were blinded. There was a kind of cult of Fred Goodwin, certainly within the bank and to some extent outside it, which was, here was a man who was putting Scotland on the map globally. He was taking over banks in America, in China, or taking stakes in banks in China. He was buying banks in Switzerland and in other countries. And, there was, I think people were turning a blind eye to some of the problems that were happening already inside the bank because of that.
Yeah, and reading the book, as you said, it really looked like there was that cult of Fred, wasn't it, Sir Fred, and everything that he, making sure that they were making decisions based on what he wanted and trying to impress him. But it's quite interesting because you mentioned that he was a bit of a bully and, almost abuses of power. So how do you think someone like that can sort of get the responsibility of such a large bank?
Well, I mean, in the practical sense, it was that he was perceived to have done quite a good job at Clydesdale Bank, which I think was already owned by National Australia Bank at that time. And he also had exaggerated his own CV, or he'd embellished his curriculum vitae, not the written one, but because he didn't have a written one, but it was about, the verbal one, in terms of he lied, I think, about his role on the global liquidation of BCCI in 1991-92, because he claimed he had basically run that process when he was a Deloitte partner, but actually he hadn't. He was a back office man. He was looking after the paper clips and the sort of not quite paper clips, but the sort of material that was needed by the partners, and the office space that was needed by the people working on that project. So he had exaggerated his role in the BCCI liquidation. There's no doubt. So these two things are critical, but also I think the George Mathewson was in a desperate state in about 97, because he'd been asked by the board of the Royal Bank of Scotland to select his own successor, which is not the correct way of doing it, but he had been asked to choose his own successor, because he had to retire at the age of 60. And a couple of people he'd approached actually had said no. Perhaps better candidate, at least two people I know of who would have been better candidates to do it, had said no. So maybe he was a bit desperate and scrabbling around for people, and he suddenly had a brainwave, inverted commas, and because having met Fred Goodwin at a Scottish clearing bankers meeting of Scottish clearing bankers, and he thought Fred was the man for the job. He has never subsequently admitted that he made a mistake in doing this. But so, I mean, yeah, these were the processes. And also Fred, I think, was extremely ambitious. So Mathewson wanted to appoint him as just the finance director, with the possibility that if he performed well in that role, he might become the chief executive. But Fred Goodwin insisted that he would only come if he was made deputy chief executive and given some form of guarantee that he would become the chief executive. So Fred Goodwin was clearly very demanding. And the nominations committee, which is supposed to oversee these things, clearly arguably failed in their duties because they didn't properly vet him.
Yeah, definitely. Because as you said, it was like everyone, all the past employees that you've talked to were like, they couldn't believe that he was being appointed, just all the stuff he'd done and all the lies he'd told. But
yeah, I think the people at Clydesdale allegedly had a 3-day party the day they discovered that Fred Goodwin was leaving to go to RBS. I've heard they had a 3-day celebration because none of them could stand him. They were so glad to see the back of it.
Yeah, but as you said, maybe a good salesman and presents himself well in the right position.
And to be fair, Fred and George Mathewson says this. Fred is a very competent person. When he, he's fantastic with detail. He can remember a lot of data. He's good in under stress in a presentation with investors and or analysts. He's not he's not a total idiot.
Yeah, definitely. And that's something that, we see that from the Nat West acquisition and sort of how he implemented it. And I think that's what gave him almost that cult status, because he did so well with that. And it's crazy to think, like, it was 3 times, Nat West was 3 times the size of RBS. They acquire it and then they implement it. So can you talk more about that and maybe how that helped him build that status?
Yes. Well, I mean, there's no doubt that the NatWest takeover was the making of Fred Goodwin, because that deal was a very intense battle for about 3 or 4 months between Scotland's 2 largest companies, the Bank of Scotland, founded in 1695, and Royal Bank of Scotland, founded in 1727. And they were really at loggerheads, fighting almost a fight to the death to take over Nat West, which was in trouble. Had been badly managed and had a lot of issues. And I think the city, inverted commas, as in the investors in the City of London, wanted it to be taken over because they felt it just didn't have a future as an independent institution. It had been rather slow, dim-witted, slow, not very innovative, and there were lots of criticism of NatWest at the time. So yeah, this was the two-way fight for NatWest, but in some ways it was a three-way fight because NatWest was trying to resist the takeover by either of those players. And as a financial journalist, it was probably one of the most exciting things that I've reported on. There was lots of leaks, there was lots of spin, there was lots of interesting analogies, and Vlad the Impaler was a phrase that was used to describe Fred by Peter Burt, who ran Bank of Scotland. And each was trying to outdo the other and denigrating the other bank and the people who ran the other bank. So yeah, in the end, after this rather fierce battle, which seemed to go on forever, it was down to Mercury Asset Management, one of the largest fund managers in the city, which decided to go with RBS. And then, like sheep, almost all the other fund managers came in behind Mercury Asset Management. Although obviously they'd evaluated it themselves, the benefit, the advantages of RBS emerging victorious, and RBS did emerge victorious on Valentine's Day 2000, and by the 6th of March 2000 they had it in the bag. But the thing is, this deal actually went to Fred Goodwin's head and to the head of others who ran RBS at the time, senior people at RBS, because they were praised to the rooftops by the investment analysts, by the investors, by Harvard Business School, by Harvard Business Review, by financial journalists, commentators, and it was described as the best banking takeover in history. So I think that definitely went to Fred Goodwin's head, and it had a big impact on what happened afterwards, because he believed the hype and he believed he could do no wrong with any deal, when obviously he could. He just got lucky with NatWest, maybe.
Yeah, and as you said, it was like it had the bones there, I think, and it was really strong, and it was really, it could be turned into a good company. Whereas we saw later, the Netherlands bank, the Dutch bank, that was the complete opposite, wasn't it?
Yes. Well, the ABN AMRO thing was a total disaster, really, because again, it was, they came in second with NatWest. They came in second. Bank of Scotland was the one to bid first, and arguably very brave. They were the ones to bid first, and then RBS came in second, and there was quite a long delay actually. Likewise with ABN AMRO, Barclays came in first and was going to take over the whole of ABN AMRO and swallow it whole and amalgamate the two banks, and clearly hadn't done much in the way of due diligence. But then RBS realized actually it was incapable of taking over the whole of ABN AMRO, so they managed to assemble in a very short period a consortium which included the Benelux bank Fortis and their old partners Santander, to take over ABN AMRO and basically carve it up between them with, I don't know if you knew the detail on this, but Santander was going to get the Italian bit and the Brazilian bit, which was actually quite a good bit. Fortis was going to get the branch banking in the Netherlands, Belgium, and Luxembourg and France, which was really worthless, which was not a very profitable business. And RBS was going to get probably the worst bit, which was the investment banking arm of ABN AMRO, which was, it made the RBS investment bank look well managed.
Yeah, and there was a talking there about where there was the US side, I think it was the US investment bank as well, that they were going to acquire, which was probably the most valuable part of it. And then that was sold to Merrill Lynch, and they still went ahead with the deal. That
was an interesting part, because it was actually a clearing or retail bank in Chicago called LaSalle. And that was the bit that RBS wanted the most to bulk up its Charter One stroke Citizens Bank arm, which was already, edging up towards being between the seventh and the third largest retail bank in America. So adding LaSalle would be a huge prize for that. And a lot of insiders were incredibly surprised when it became crystal clear that LaSalle would no longer be available. that the RBS board decided to carry on regardless. And actually, to some extent, Reichman Groning, who was the chief executive officer of ABN AMRO, played a masterstroke when he managed to, over the course of a weekend, sell LaSalle to Bank of America, it was, in fact. Basically, it's almost like a poison pill defense, because that was the one bit that RBS supposedly wanted the most.
Yeah, definitely. And then, but I don't think they even got paid for that in the end, did they? Well, that's
No.
which is funny. But we'll sort of go back to, let's say, NatWest. After they acquired NatWest, they integrated it very well. That almost started the world domination and just the goal to, make it bigger and bigger and bigger. Was that just RBS, or was that sort of banks in general at the time, do you think?
Well, investors must bear some of the blame, because they were certainly wanting growth. They were wanting growth by acquisition. They didn't bulk at growth by acquisition. Although they did, once they realized that Fred wasn't actually that good at making deals, especially after the Charter One deal in America, which was a $10.8 billion acquisition of a bank in Cleveland, Ohio, called Charter One. That was a turning point too, because the investors began to, they realized that Fred Goodwin and the RBS board had overpaid for some real drop, what may well have been some real drops, laced with a form of subprime lending, and which turned out to be probably worth only about $2 billion at most, rather than 10.8. So I think there were various stages. There was a period between 2003 and 2005 when Fred Goodwin was still walking on water and deals were still going right. And he'd taken over First Active in Ireland, and was aiming to transform that by amalgamating it with Ulster Bank into Ireland's largest bank. And various other acquisitions were seen to be going relatively well, and the integration of NatWest, as you said, was seen to have gone relatively well, or very well, in fact. And the cost cutting that he'd achieved at NatWest had been enormous. He'd sacked 18,000 staff, which is horrendous for the people involved, but as far as the investors were concerned, this was good. And he'd create these things called manufacturing centers, where basically they moved all the processing side of banking, including printing checkbooks, which still existed or still were widely used at that point. So at that point, between 2003 and 2005, I think he was doing okay in the city's eyes. Although the share price was plateauing already. It was beginning to plateau. And then in 2005, I think that the turning point came with the April 2005 acquisition of Charter One. And that's when investors basically said, you've got to put him in a box, and told the board, you've got to tie his hands. You can't allow him to make any more acquisitions, because this one is a disaster. And that's when there was a rift in the board. The board became dysfunctional. George Matheson, who was then the chairman, was not on speaking terms, allegedly, with Fred Goodwin. And so there were some serious issues around that time. And a lot of the senior insiders say at that point, with the benefit of hindsight, they should have fired Fred Goodwin, but they didn't. They basically said he could continue on a number of conditions. And the key one was that he had to give up his deal-making mania and focus on, inverted commas, organic growth. And so that was a decision that was forced on Fred Goodwin in mid to late 2005.
But then they didn't keep him up to it, did they? Because obviously we talked about the acquisition later, and there was the Bank of China, or one of the banks in China. They was a 15% or something like that. So they just kept going and going. But I guess people were maybe in massive hype of the markets and how well everything was going. That may have helped.
Yes. I mean, there was another thing, which was the so-called Brunswick report, when they basically asked a PR firm called Brunswick, which is one of the city's largest PR firms, to assess how Fred Goodwin and RBS was viewed by investors. And that was part of this turning point that I was describing. Basically, they said, he's a megalomaniac. Well, words that apparently were in it, and I haven't actually seen the document, because I don't know how. I have not been able to obtain an actual copy, but I've interviewed numerous people who have read it, And they say words that feature include megalomaniac and total CUNT. I can't remember the other one, sorry.
So yeah. I think that gives a good picture of how not only his employees thought of him, but how everyone else thought of him.
Yeah.
But that's super interesting. I think the thing as well that I found so surprising was he was telling the investors and probably everyone else, no, we're not going to buy anything. We're not going to acquire. 3 months later, they'd do it. And then there was almost like, because RBS was quite undervalued, wasn't it, compared to other banks because of Fred and him being in charge.
Yeah, they called it the Fred discount. Well, that's what George Matheson called it, the Fred discount. Yeah. And I think that what was I going to say? I think basically it's like a drug. You know, once you've got this deal-making drug of growth by acquisition and just the excitement of doing the deals, it's very hard to get rid of it. And I think that probably did persist, not just in Fred's mind, but also in the minds of others within RBS. So yeah, it's an interesting case study of, saying one thing and doing the other. And there was one particular journalist called Peter Tal Larsen who highlighted this in one of the many annual results conferences they had in their Bishopsgate Theatre. And I can't remember the exact words, but it was, he was basically asking given the rumors about Bank of China, was he going to adhere to his new mantra of no more deals?
Yeah, and it's crazy to think sort of how much he got away with. And we also mentioned there that they had the private jet, they had the millions and millions of dollars going to the F1, to different sports stars and stuff. So it was just a spending spree. And as you said, he just got so confident, he thought it was going to last forever, probably.
Yes, I could tell you a story about that. The ex-chairman, who's a man called Lord Younger, George Younger, former UK Defence Secretary, Tory politician, and former chairman of RBS, was on his deathbed actually in a hospice in I don't know if this is appropriate on his deathbed in a hospice in central Scotland, somewhere in Stirlingshire. And his daughter, Joanna Younger, who also worked for RBS, was present. And Fred Goodwin came to visit him in the hospice as he was, on his way out, unfortunately. And Fred Goodwin had two things with him, two things to show George Younger. The first thing was the architect's plan for the new world headquarters at Gogarburn, just near the airport in Edinburgh, which was then beginning to get under construction in 2002. And the second thing was a photograph of the Dassault Falcon 900E private jet, which he just ordered. And he was terribly enthusiastic about these things and saying, this is our new headquarters, and showing it to George Younger and to Joanna Younger. And this is our the plane, that will be delivered in a few weeks, blah, blah, blah. And just after Fred Goodwin left the hospice, George Younger said to his daughter, I think we'd better sell all our RBS shares.
Yeah, and you mentioned in the book, it's crazy that he just knew what was happening.
Yeah.
But I guess that sort of shows you, as you said, just, what was happening there all went to his head. There was a cult behind him, he could do no wrong. And it's almost surprising that, when you look back at it, it looks like they were so incompetent, but they just didn't understand what was happening. Do you think that was the case? Did they not understand? Was it just too big to understand what was really happening?
Well, I think the obsession with growth at any cost was a key factor, and the obsession with scale, which is the same thing really, and whether that was through acquiring assets or acquiring assets as in financial assets or acquiring other banks, they didn't seem to care. And the other thing, so there was very little discrimination in terms of the asset quality, far too little. Another thing is, hang on, what was I going to say? Oh yeah, incompetent governance and weak governance at board level. So you had, after George Matheson stepped down as chairman in April 2006, you had a new guy called Sir Tom McKillop, who had been chief executive of AstraZeneca and was a chemist by profession. And he built, to his credit, he had built AstraZeneca into one of the world's leading drugs companies after it was spun out from ICI. So he wasn't, he was a very competent manager, and he was highly regarded at AstraZeneca, but he didn't really understand banking. His only experience of banking was sitting on the Lloyd's board, Lloyd's TSB as it was then board. And as a non-exec director of a bank, you don't really understand banking. I don't think if you work as a non-exec director of a large bank for say 5 years, you can't really pretend to fully understand banking. But anyway, so he came in, and then in a classic RBS meeting offsite, which they had at Gleneagles Hotel in Scotland in June 2006, they were debating, what to do and what was the best way forward for the bank. And this was the time when already Goldman Sachs, JP Morgan, and one or two more clued up US investment banks were realizing the subprime bubble was about to burst or could explode at any time. So they were de-risking their portfolios, or beginning to. But allegedly, and it's in the book, Sir Tom McKillop at this meeting decided to be really gung-ho and go for, inverted commas, organic growth, and focus on derivatives and securitizations and the sort of opaque bundles of debt, which the US, but the savvy banks like Goldman and JP Morgan, etc., were already trying to offload. And so this was a fateful decision that RBS made in June 2006, that it was going to ramp up its presence in probably the worst possible sector.
Yeah, and it's crazy to look back at how that happened. And it's surprising how large RBS was. I think, I might not be getting the numbers right, but I think it was the largest bank in terms of assets, over 2 trillion.
Yes.
So how can you explain sort of how the company was that big? Was it just acquisitions and looking at growth like crazy? And sort of why did it have such a big impact on the UK economy as well? Because obviously when it collapsed, there was fears that, the whole society would collapse.
I think one of the reasons it got so big was because it ballooned its investment banking operations, which became by far the largest part of RBS by 2008. And that was through, a lot of, basically some cheating in the markets, but a lot of accumulation of really duff assets, including some of these CDOs, the toxic bundles of US housing debt and other toxic bundles of other forms of debt. And so that was one way it was growing, but also, 26 acquisitions between NatWest and ABN AMRO, many of which were other banks, and many of which were actually in America, which were latched on, which were joined on to the Citizens Financial Group, which has now been sold off. But the real killer was obviously ABN AMRO itself, because the financial regulators in the Netherlands had said that even though it was being carved up by Santander, RBS, and Fortis, for a significant period, RBS had to hold the whole of ABN AMRO on its balance sheet. And I believe, I probably need to double check this, but I believe that was still the case in October 2008, when RBS, still technically the case when RBS started to collapse. So it's astonishing to think that RBS, what had been an inverted commas provincial bank in say mid-90s, which had a small presence in the Manchester area through Williams and Glyn's, and that was about it, had mushroomed into this global behemoth, trying to be all things to all people, trying to be a global universal bank in the same way as HSBC was trying to be, and in the same way that various US banks were trying to be, but without really the knowledge or understanding of how to run a global international universal bank.
Yeah, and it was all looking at it from a British perspective rather than, because obviously all these places are so unique, aren't they, in how they run?
Yeah, and you saw that particularly with the cultural clashes that occurred with the ABN AMRO acquisition, which I describe in the book. And basically there was a complete desire to force their way of doing things on firms they acquired, or the bits of the firms they acquired, including ABN AMRO, which basically isn't necessarily the best policy. And the assumption that your way is best, whenever your way of doing everything is best, when clearly it isn't. It was another issue. But in terms of the risk to the UK economy, I think its balance sheet was about between 2.2 and 2.5 trillion. No, is that sterling or dollars? You probably know.
I think it was dollars, but yeah, it's still massive either or.
Yeah, and it was actually larger than British GDP at the time. So the risk of that thing collapsing to the British economy was immense. And I can now, I can understand why Alistair Darling, who was the then Chancellor, was so petrified and was prepared to pull out all the stops to ensure that RBS did not collapse.
Yeah, there's a very eye-opening part in the book where I think you talk about Gordon Brown and Darling and what they're talking about, where they were fearing that people couldn't get money out of machines, that people couldn't buy things, that there'd be riots in the street, and then they're saying once that can opens, there's no putting it back in. So I think that was the main concern, wasn't it?
Yeah, they were talking about blood on the streets, and they were literally shooting bricks. Excuse the language, shooting bricks. They were terrified that if this thing, there was one particularly fateful phone call that happened. I think it was on about the 7th of October, 2008, when Alistair Darling, the UK Chancellor of the Exchequer, was at a meeting of European finance ministers in Luxembourg, and he got this phone call from Sir Tom McKillop, the chairman of RBS. And the key part of it was Darling asked McKillop, "How long do you think the bank can survive?" And he was hoping he was going to say weeks or months, because they had to get their bailout package, which they had been working on, ready, ready before in time for the collapse. But Tom McKillop said, "Well, it's going to be we can only survive a few hours," was the exact words, I believe. And that, I think, put the fear of God into Alistair Darling. And as I said, at that point, he realized that basically they had to do whatever it took to ensure that RBS did not collapse. RBS, by the way, was unable to fund itself. The reason it was on the brink of collapse was post Lehman Brothers collapse on the 15th of September. There'd been a freeze in the interbank lending market, and RBS needed to roll over some of the deposits that it was getting from other banks, literally on a 24-hour basis, and that they didn't trust it anymore. And I think it was Johnny Cameron, who was the ex-head of the global investment banking arm of RBS, who said one of the key issues was that they were willing. Each individual bank was willing to park 100 million or whatever it was with, say, ABN AMRO when it was a separate bank, and say $120 million with RBS when it was a separate bank. But when the two came together, it wasn't willing to put 220 into the combined bank because it was had become. It was basically concentrating the risk. So getting the funding was the critical issue, getting the short-term funding. And they'd also paid 90% cash for ABN AMRO rather than paying a larger proportion in shares. So, yeah, they were really in trouble, in serious trouble by that point.
Yeah, definitely. And I think, I'm not sure if this number's right, but I think it was like 100 billion a day or something that they had to borrow or might be less.
It was vast, and I think I think that they were hammering the phones trying to persuade people to help fund them, but basically there was a lack of appetite, and it must have been really quite an extraordinary time if you were in, say, Johnny Cameron's shoes or the shoes of someone who was trying to get the funding in those perilous few weeks between the collapse of Lehman. It was basically 3 weeks between the collapse of Lehman and the collapse of RBS.
Yeah, I think that's the issue is that when it goes down very quickly. So you don't
Yes.
often have much time to fix these things. And, we talked about the government met there, and I think it was the FSA at the time, but now I think it's the FCA. So sort of what role did they have in the actual overall collapse? Do you think they had a big role in it? Or?
Yeah, I think they were basically semi-comatose, from roughly 2004, 2003 onwards. They didn't have enough people looking at RBS. I mean, to their credit, when there was a period of dysfunctionality at board level, they did actually try to gain greater insight into what was going on at RBS, and they tried to. Well, they said they wanted to have an FSA, as it was then called, observer, sitting in on each board meeting, and they also wanted to, on a one-to-one basis, interview each of the non-executive directors and possibly the executive directors of RBS. But what I found quite interesting was that this really enraged, these requests really enraged RBS, and they said, "What the hell's going on here? We're fine. Why is this pesky regulator wanting to sit in on our board meetings or interview our non-exec directors on a one-to-one basis?" And so my understanding is that somebody, possibly George Matheson or possibly Fred Goodwin, went to number 10 Downing Street or to number 11 Downing Street and told Gordon Brown, who was then the Chancellor, what the hell is going on? Why is this regulator wanting to meddle in our affairs? Why is this regulator wanting to monitor our board meetings? And my understanding, I haven't actually had this confirmed, is that Brown or Ed Balls, who was very close to Brown at that point, went to the regulator at Canary Wharf and said, "Back off, then they're not doing anything wrong." So there's an interesting relationship there. But certainly the mantra of the FSA throughout this period was light touch, limited touch, as in don't bother to probe things too deeply. They hadn't bothered to investigate the ABN AMRO takeover. Was this safe for financial stability in the UK? They hadn't bothered to investigate any of the other acquisitions that RBS had made. The guy who ran the FSA, the chairman, who is an ex-Barclays Bank investment banker, called Sir Callum McCarthy, he didn't really believe in regulation. He didn't see the point. He thought markets would basically resolve everything. And he thought that since banks were answerable to their shareholders, they would behave responsibly because the shareholders would make sure they did, which was an incredibly naive view, but that was the view that he had.
Yeah, and then we sort of realized that these banks can lie to their shareholders or hide a lot of the issues. And
yes,
I think one thing you mentioned as well, there were alarm bells, and even some people in the FSA and other places, they were actually sort of suggesting, that these are issues. But as you said, I think be it from Brown or the head of FSA, they just said, no, let it go.
Yeah, I believe so. I mean, I wasn't there, but my understanding is that there were a lot of flawed assumptions, not just the top level of the FSA, but all the way through the FSA. And this could be summarized as leading bankers can be trusted, leading bankers know what they're doing, and leading bankers have integrity. And those were the three of the assumptions that they had. And I did meet a senior FSA person just after the crash of 2008, and he said these were the assumptions. And he said that after the crash of 2008, we turned them all on their head, and we realized top bankers could not be trusted, top bankers did not know what they were doing, and top bankers did not have integrity.
Yeah, and I think as well, they look at the reward, how they rewarded, it was all based on growth, and it was all based on the things that wasn't about the stability of the actual bank or even the economy. It was all just grow, and look good for investors.
Yes,
definitely. So yeah, and obviously it's a crazy situation. It got to the point where I think it was, the government had to come in, they had to bail out the bank. I think they bought 80% of the shares at one point. So basically nationalization. And I think it was 24 billion or something like that loss in a year, which is amazing to think.
28 billion for the year ending December 2008. Biggest loss ever made by a British company, I think.
Well, yeah, it is absolutely, like, you think of these numbers, and it's even today, it's crazy to think. So, Do you think there was another way? Should they have nationalized it? A lot of people have said they should have let it fail. Maybe free markets. What's your opinion on that, or maybe what other people think?
Well, I interviewed Jim Rogers, who's an investor based in Singapore, and he said, basically, if you rescue failed institutions, the people disperse and they go and run other ones, and then those fail because they apply the same mindset they had in the ones they worked for before. And he said that happened after long-term capital management in '97, which was the hedge fund that collapsed, that had to be bailed out by Wall Street. So yeah, I think there's a case, and it might seem very naive, but I tend to agree with Joseph Stiglitz, the professor of economics and Nobel Prize winner from Columbia University in New York, who says that you could have actually ring-fenced the critical part, which is the UK commercial and retail bank, and then put the rest of it into an orderly wind down. And so that may, with the benefit of hindsight, been a better solution. But I understand why Darling and Alistair Darling and Gordon Brown, with their advisors who are from UBS and other investment banks, chose the solution they did. But with the benefit of hindsight, the solution they chose, which was effectively nationalization, and with the asset protection scheme, which is something we could also discuss, it has not been great for either RBS, NatWest, or the customers. So in the short term, it avoided a huge economic catastrophe, but in the long term, the lack of conditionality that was attached in terms of behavioral change, structural change, even just the payment of bonuses to top bankers, there were far too few strings attached to these bailouts, as far as I'm concerned.
Yeah, definitely. And then we saw, you mentioned afterwards what happened after the crash, and when it was, nothing really much changed over 7, 8, 9, 10 years, really, did it? And there was still these accusations. They're still paying for everything that happened under the past leadership.
There was a very senior person in the investment bank who gave a speech to investment bankers within RBS in March 2009, and said that the thing was still yet to be fully stabilized and was looking pretty rocky. But as far as he was concerned, Stephen Hester, who had become the chief executive, was the man who would have all the meetings with the government. And the bailout, he more or less said, the bailouts mean we can just carry on doing as we were doing before in terms of bonuses and in terms of risk taking, et cetera, et cetera. It just shows that basically that there was very little cultural change at RBS, even though it owed its it owed the fact it had continued to exist to the generosity of British taxpayers and the central bank.
Yeah, and
the Fed.
Sorry, yeah, and it still treated its customers poorly, and it still treated its employees poorly, and it didn't really improve after, I think you said Heston, who's the new leader who came in after Goodwin obviously got sacked, and it didn't improve at all, did it?
No, well, I think Hester's attitude was pretty naive, to be honest. Stephen Hester basically had this view, and it had this view that you could just ratchet up the investment banking activities and then flip it back into the private sector within 2 to 3 years. So that means by 2010, 11, and at a profit for taxpayers. So, he was an ex Credit Suisse investment banker himself, but he had this, what I would consider a very naive view about how quickly RBS's problems could be resolved. And he didn't tackle the underlying problems.
Yeah, the cultural problems and everything that happened there. And so if we look at it today, so obviously it's been 13 years or so, do you think those cultural issues have been tackled? Do you think it's recovered a bit better than obviously what it was then?
I do think that Hester talked a good game, and I think he did achieve some things, including shrinking the bank. He did get rid of a lot of the assets, often at fire sale prices. classic example there is WorldPay, which was a merchant processing company for cards, credit cards, debit cards. And that was sold off for, I think, $2 billion. And it's now got a market cap of more than RBS, RBS now known as NatWest. I think its market cap is in the high 30s of billions of dollars, and which is more than the market cap of the original parent. So yeah, the forced sale of good businesses actually is an interesting one, because Citizens is now worth almost as much as RBS. It's a separately listed bank, listed in America. WorldPay is a separately listed institution. So they were forced to sell these things at the very trough in the market, because that's what the regulators were wanting and what EU was wanting. But arguably that hasn't been to their benefit. In terms of culture, I'd say, it didn't really improve under Stephen Hester. I think the New Zealander who took over, Ross McEwen, marginally improved it. Or some people claim he improved it a lot, but I'm more skeptical about that. And Alison Rose, who has been the chief executive since 2019, she remains a bit of an unknown quantity as far as I'm concerned. I mean, the main reason I doubt whether the culture has changed is the way they treat aggrieved small and medium-sized enterprises who suffered abominably at their hands, and really for no real reason, actually. Between 2009 and 2013, this is the so-called Global Restructuring Group scandal. I do know a number of the victims of that, and they are not being treated very fairly, or really with any real fairness or understanding of what the bank did to them. And really, my issue is until those people until they are properly compensated for the losses that has happened, the bank has caused them to suffer, then the bank's culture will still be not be that great.
So sorry for interrupting, but just a side note from Ian on this particular question about NatWest's culture changing, as two very recent developments have occurred which further support that maybe things hadn't really changed that much after the issues they had during the financial crisis. So firstly, on the 7th of October 2021, NatWest pleaded guilty to 3 criminal offences of money laundering under UK money laundering regulations. The offences occurred between November 2012 and 2016 and related to the accounts of the now defunct Bradford jeweller Fowler Oldfield. Examples of what happened included black bin liners stuffed full of cash being deposited, and some so large that one branch's 2 floor-to-ceiling safes provided inadequate storage for the money. They recently received a fine of £264 million for these issues. On the 2nd of December 2021, the EU fined NatWest €32.5 million for rigging foreign exchange markets as part of the Sterling Lads cartel. Other banks involved in the cartel were also fined. The EU fines follows earlier blockbuster fines for RBS and NatWest for foreign exchange market manipulation. In April 2014, it was fined $1.3 billion for forming a 6-bank global cartel to rig FX markets by US, UK and European regulators. In May 2019, the EU fined RBS €249 million for forming other FX marketing rigging cartels, including Three-Way Banana Split and SX Express. According to regulatory settlements, most of the legal activity ended in 2013. So I guess it shows sort of after Goodwin got out, maybe things didn't change too much, but after 2013, hopefully things got a little bit better. Yeah, and it's crazy that like there's a time, an example in the book, where you mentioned this lady had a signature forge, and they only offered her, they didn't even offer her anything to start with. It gained a bit of media attention. They offered her like £500, which is nothing in the grand scheme of things. And these companies were sold interest rate protection, which they really didn't need at all, and just there's PPI as well, which has been massive in the UK. All these things.
Well, you see, the classic case to me is when RBS was found to have on an industrial scale missold interest rate hedging products to its customers between 2005 and about 2009, and it actually skewed the review by actually falsifying information in terms of what people had agreed to on the phone, whether a particular meeting had occurred on a particular date to approve the hedging products. And in many cases that I'm aware of, actually RBS made stuff up to pretend that, the guy had agreed the person had agreed at a certain time and a certain place to take out the IRHP product. And in order to reduce the amount of compensation that it would owe. And I do think that, personally, I think that's despicable behavior. And it shouldn't be able to get away with it. If we had if we had a regulator with teeth, who was actually on the consumer side and the user of financial services side rather than the side of the banks, then they wouldn't allow that sort of thing to happen.
Yeah, definitely. So it's crazy to think, and as you said, they've ruined hundreds of lives, thousands potentially. So do you think those have changes been made for maybe the regulation? Do you think more changes need to be made? What's your opinion on that?
Well, basically, there's been a few macro changes, including the so-called ring fence, which is a basically softer version of Glass-Steagall, which is separating investment banking and retail banking. But that's been watered down through lobbying from the banks. We have got requirement for much higher capital ratios in UK banks that have been introduced from the mid 2010s onwards by the Prudential Regulation Authority, which is part of the Bank of England. So yeah, you have got some improvements. Then they're not so likely to fail now, and they are arguably, the culture is marginally improving. But I do think generally the regulator in this country, which is called the Financial Conduct Authority now, the conduct regulator, has not covered itself with glory in the past 8 years. It's only existed for 8 years because the FSA was split in 2013 into PRA, which is the macroprudential part, and the Financial Conduct Authority, which is the microprudential part. It's called, for some reason, it's called the Twin Peaks model of regulation. But yeah, I mean, the FCA has been a massive disappointment. And the fact that the person who runs that is basically a man whose priority is to market London as a base for financial services companies, with still a light touch regulatory approach to financial regulation, is not great. He's called Nikhil Rathi, and he used to run the London Stock Exchange, where his main agenda is to lure companies which wish to IPO or to list their shares on, it's to market London as a financial services location rather than to ensure customers are treated fairly or there is sufficient consumer protection. And I do think they need to up their game.
Yeah, definitely. As you said, there's conflicts of interest there. It's almost like a salesman trying to bring more people in.
Yeah.
Yeah, definitely. And you mentioned there sort of they have more capital now, because I think we haven't mentioned it. I think at one point RBS had 70 times leverage or something ridiculous like that, which is, horrifying to think.
Yes. Well, they are talking about returning capital to investors now via share buybacks and things of that nature. So yeah, they obviously have a surfeit of capital now, which is completely, polar opposite to what they had in 2008. 2008, they were like a galleon with every single sail out in a storm, and they were bound to get knocked over. But now at least their rigging is a bit more in order, and their capital rate. I think their capital ratio is whether it's the core tier one or not. I can't remember the exact terminology, but I think it's around 16%. When I think at the worst point in 2008, when they did their flawed rights issue, it was more like 2%, in that sort of ballpark. So yeah, there's been a huge change around in terms of the amount of capital they have on their balance sheet.
Yeah, which is very positive. So if we look at sort of like, I guess, the whole story of RBS, the whole writing of the book, was there anything that really surprised you, or anything that really stood out to you, or maybe shocked you as well?
Well,
we haven't talked about maybe.
Well, I think to me the most shocking thing was that Fred Goodwin was not as mad and bad as he was always made out to be. And whether it's shocking, I don't know, it was surprising. For example, when LaSalle was no longer on the menu, he allegedly went to see Emilio Botín, who was the chairman of Santander, and allegedly went down on bended knee and begged, can we withdraw? Because, the bit we want is no longer there, it's no longer available, and this deal no longer makes sense. And obviously the credit crisis was beginning to erupt during 2007, especially in August 2007, when this was happening. So the fact that he did try to extricate himself from the ABN AMRO deal was perhaps the thing that surprised me the most when I was writing it. And I think Santander's response was just classic, which was to say, basically, no way, Fred. We helped you to buy NatWest, which they had in 1999-2000. We've made an agreement, as in Geneva agreement. We've made the agreement in Geneva, and if you try to extricate, or if you do pull out, then we'll sue you till you have not a penny left. This is allegedly what Emilio Botín told Fred Goodwin when he tried to extricate himself. But again, this is one story, because bankers are very difficult to pin down, to actually verify some of these facts. This particular story may well be apocryphal, but it does have the ring of truth about it to me.
Yeah, and I think there was you mentioned there was a meeting, and they're saying when you're in Santander, like when you're in a position of power, you take it, and they definitely took it, because I think they, 2 months after the acquisition, they'd already sold off, I think, the Italian bank for quite a big profit. So
yes,
they'd done very well for themselves.
And the classic scenario, which it wasn't shocking, but it was kind of interesting, of the meeting in April 2007, when the three amigos, as they were called, were planning their carve-up bid for ABN AMRO, and basically, from what I can gather from multiple sources, Emilio Botín was basically playing Fred like a violin and flattering him to the heavens, saying he was the best banker of his generation, all the while with his hand metaphorically in Fred's back pocket.
Yeah, that's a great way to look at it, and they did very well. So, Ian, thank you so much for your time. It's been a great interview. So, just on to my last question. Sort of, what is one message that maybe you'd like viewers to take away from our interview?
Okay, well, we definitely need more root and branch reform of the banking sector. We've seen it with the Royal Commission in Australia, where all sorts of shenanigans and ripping off customers came to light through that Royal Commission. And what we need is politicians to actually remember that they are voted in by the people, and that people who have they should ensure that they represent the people. And if bankers are behaving badly and fleecing them, ripping them off, forging signatures, costing them a decade of austerity through their own failure, through the failure of their institutions, then it's up to the politicians, I'm afraid, to really address these matters and rein in the banks. But the trouble is the banks have basically huge lobbying power as well. So
yeah, and we've seen that recently with the auditors. They were trying to bring in more powers on them, and they lobbied against that, and it didn't work. So I guess it is very challenging, and it's so interesting. If an individual does it, they get crucified, but if a big bank do it, then nothing happens.
Yes, exactly. There's an unevenness of power. There's an uneven. There's a two-tier legal system. There's a two-tier justice system to some extent. Big banks seem to be able to get away with things which, if an individual did, the individual would find themselves in jail. And that Mrs. Mackay case with RBS is a classic example. If she'd forged a signature on an important document, the chances are she would be severely prosecuted. She could be prosecuted and could even go to jail. When a banker does it, it's just basically it's not even investigated.
Yeah, they just sue. They just keep the legal system process going, so the person can't pay it. But Ian, thanks again. So if anyone want to get the book, or maybe read some of your more of your work, what would the best place for that be?
Okay, well, this is the book here, Shredded, Inside RBS, the bank that broke Britain. you can really buy it almost anywhere. You can still buy it in some bookshops. You can get it from online from Waterston's. You can get it online from the publishers, Berlin. You can get it online from various other places. In fact, there's a particular website which amalgamates the sales of lots of independent bookshops, which I can send you if you wish.
Yeah, Jeff, I'll put that all in the description. And do you have any other projects coming up, or nothing at the moment?
Well, I am working on another book, but it's sort of under wraps at the moment.
Okay, no problem. When it's announced, I'll have to get you on to talk about that one again. So,
okay,
Ian, thank you so much.
Great talking to you.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.